Every day, traders and investors dive in to tackle the ever-changing markets to find opportunity. Futures Radio Show is your number one source for answers to the questions that all market participants want to ask. Veteran futures trader Anthony Crudelli sits down with the most influential leaders and top traders in the industry. Now, here's your host, Anthony Crudelli.
Welcome everyone to episode 155 of Futures Radio Show, recording here live at Trading Technologies in Chicago. Now, since we are live, we are going to be taking questions at the end in our audience and also through Twitter. Use the hashtag NightOutFRS. So, I have my two friends here, Rick Santelli and Ira Harris. Guys, welcome to the show.
Thanks, Ed.
So, every show begins with hearing people's backstories. And the two of you are so interesting, and I can't wait to hear how you got your start. We've already been talking a little bit with Ira about how he got his start, so let's go right to Ira and go, Ira, how did you get your start in the industry?
Again, Anthony, as I was saying, a friend of my dad's asked me, he was a trader in the cattle, and in 1972, as Dave talked about, they launched the IMM, which was the International Monetary Market, the year after Bretton Woods fell apart. But I was actually in college, in graduate school, studying that. And it was 1975, 1976. And there were German elections. And my dad's friend calls me up. And he's one of the great characters ever at the CME anyway. And he says, hey, your dad tells me you know a lot about foreign currencies. He says, I want to buy some Deutschmarks because of the elections. What's going to be the impact? So I wrote him a 3-page paper. I mailed it to him. He makes the trade, and it works. So I leave graduate school because there were no jobs. I thought I wanted to get a PhD, but forget it. There were no jobs. I would sit and watch people who I thought were really bright. So I moved back to Chicago, and I was reffing basketball and working with kids, emotionally disturbed kids, and doing all these books, reading all these novels I want to read. And he kept calling me. He called me once. He said, hey, I'm starting this business in the currencies. Why don't you come work for me? I go, no, I hate the place. I said, I know all these guys down there. I can't stand them. Called me again. He says, I said, no. So now it's about 6 months go by. And he says, this is the last time I'm asking you. He said, I want you to come down. I want you to work. This is going to be a great opportunity. I said, now I'm getting a little bored. I'm living at home, reffing high school basketball. I was getting a little so. I said, okay, let me give it a try. So I applied for membership in probably February of 77. So I started in May of 77, and till the day he died, and he passed away in December of 2015. He was 89 years old. He would always say to me, and we would talk 3 times a week. We still stayed phenomenally close. I miss him tremendously. But he'd always say, you were only coming for a few weeks. What happened? He said, I couldn't get you out of there because it was the perfect time. Now, the world was exploding in 1977 in the financial realm, and I was not by any great planning of myself, but it was a very fortuitous opportunity. And as the exchange grew, I really got to grow with it, and it was great. And I had great mentors. I can't go through them all. The problem with the electronic world is you don't get mentored the way we got mentored. Yep. We were laughing about it before. I was, Vince Schreiber, you don't even know who he is. He died. He was 60 years old. Phenomenal order filler, great trader, but he was such an honest order filler. He never traded where he filled orders. Imagine that. And he was a great trader because he thought it was unethical to do so. He was a mentor. I'd go out on Rush Street at night, and I'd see him, and he'd have 2 bottles of champagne going, and he'd say, hey, kid, go get some from Let 'Em Eat cake. I'd come back with a dozen eclairs, and he would sit there teaching me about the markets. Phenomenal. And I can go on and on. There were people like that. I had a lot of great mentors, which is why I blog and why I do stuff with Rick. And they say, why do you do it? I said, well, it helps me get my thoughts. But there were so many people who took time to mentor you, to take the time to teach you. I'm very fortunate. I think that's what the industry misses today. So actually, your radio show does a lot to make that do it. Rick is for professionals. You know, all the professionals I know, they turn up the volume, and they'll tell you that. When Santelli is on, the volume goes up. Most of the time, it goes down. Same for Art Cashin, because people want to learn that. They're there to teach you. They're not touting you. You know, it's like when I come on with Rick, I don't sell anything. The only thing I ever sold, and they're giving it away free tonight, so make sure you take all the copies you want, is the book, The Rotten Heart of Europe. And that was as a favor to the author of that book, Bernard Connolly. And if you really want to understand what's going on in Europe, and the fact that he wrote it 22 years ago, and it's more relevant today than it was 22 years ago, that was the only thing I ever offered. So it's not about selling, it's about giving, and that was the sense of really giving back to the industry, because it was great. It was some of the greatest people you could ever have met.
No, it's great hearing that. And when you mentioned Futures Radio Show, filling that void, it was one of my first ideas as to why I wanted to start Futures Radio Show, to be able to talk to you guys and share these stories and carry on the legacy of the industry.
Well, you know, and I'll end with this, but as Dave talked about your Leo Malamed, my wife is here saying, Leo Malamed is a good friend of mine. We don't always agree about things, and when I sat on the CME board, we would have our, but that's just the way I am. But a guy like that, a great visionary, and be able to sit and talk to him, and of course I always had to go to a neutral site after the politics weren't good, so we would always find a neutral place to go. But I mean, that's a visionary. That's a visionary. Yes. You know, people forget, he had to cajole the board members at the CME to start the IMM. And what people don't know is that if you were a CME member in 1971, 72, the IMM started, you were given an IMM seat, $100, if you were a CME member. And if I tell you how many of those were never elected to be bought, you'd be amazed. But he had to fight every day because the old meat traders, they said, what do we want this for? This is garbage. You know, this will never go. You know, everybody had an idea.
The S&Ps?
Oh, yeah.
He was handing out buttons,
Yeah.
15 minutes.
Yep.
And if you didn't go in that pit and spend 15 minutes, he would pound you.
Oh, believe me, I got slapped every day leaving the floor. Where's your, he has to see my trading cards. How many trades did you make today?
Yeah. Great stuff, Ira. Rick, how did you get your start?
My story is not nearly as interesting as any of those. I was on my way to law school. You know, I graduated from U of I was enrolled in law school, and I was dating a girl whose father was just a really cool dude. He was a pork belly trader, and he went back into the 50s when it was on Franklin, one of the legends, Lawton Lamb. And I remember I had to meet my girlfriend's dad, and I was a little bit nervous. So you walk into the old CME, not too far from here, and I saw the visitor center. That was it. Game, set, match. In 2 minutes, it changed my life. I saw the visitor center. I walked downstairs. First person I bumped into was a lady named Sandy Donovan. She was running Shearson's desk at the time. And I said, how does somebody work down here? She goes, I need a runner. I said, I don't know what a runner is. What does it pay? She goes, $60 a week. I said, I'll take it. All within the first 5 minutes. And boy, you should have seen how pleased my parents were when I came home. I said, Dad, I'm not going to go to law school. I just took a job for $50 a week down at the Chicago Mercantile Exchange. He says, what the hell is that? You're going to be selling sweaters? Best decision I ever made. Within 2 months, I begged, borrowed, and steal and leased an AAM seat, which was lumber. I think it was technically lumber, eggs, and potatoes, but they only had lumber. And in the lumber, they had these two guys called the Ritten Brothers. I didn't stand a chance, but man, you talk about an education in trading. I'll never forget my first day. I was shaking so much, so I'm filling out this card. And I bought one lumber from one of the Ritten Brothers, ND, I think his badge was Notre Dame. The market went limit up. I'm like, holy cow, I'm rich. My first trade, it's limit up. About 2 minutes later, I feel a tap. It was the other brother, the other Ritten brother. He goes, kid, get out of that. I'm looking at this guy going, man, I'm rich, it's limit up. He goes, I get out of that if I were you. I didn't listen. All of a sudden, he turns away from me, goes to the pit and offers it limit down. On the way out, he goes, I told you. And that was my baptism through fire. I'll never forget that. Listen, in terms of TV, also a complete accident. I knew a young lady who now works for the Chicago Fed. Maybe she'll find a better job in the future, but she used to be marketing and public relations for the CBOT under Pat Arbor. And in the mid-90s, they changed the turnstile rule. In those days, prior to about 94, if you were going to talk about the markets with anybody in journalism, or TV wasn't really interested, but the few occasions something would happen and they would send cameras out, you couldn't do anything on this side of the turnstile, you had to do it on the other side of the turnstiles. Well, they changed the rule. And all of a sudden, Reuters TV, which is no longer in business, decided they want to interview a trader. And Pat Arbor was the head, and he says, okay, Laura, this is your job. Go find somebody to go on TV. She was asking everybody. At least she tells me she was asking everybody. They said no. And I remember I was running to the turnstiles. I was working for Drexel at the time, and I feel a tap on the shoulder, and she says, you got to do me a favor. I'm thinking, okay, what do you need? Coffee? What do you need? She goes, follow me. All of a sudden, and this was the old Board of Trade floor, we're walking on the catwalk, which wasn't made for humans, man. You know, Mansfield gave that up. That thing was rickety. They had me, a camera guy, I had no idea what was going on. The green glow of the boards is on our face. All of a sudden, I'm on TV. I had no idea. I was petrified. And believe me, the first couple, and then I started doing Channel 26, Meet an Expert with Jack Taylor on like the 42nd floor of the Board of Trade. But to make a long story short, if you do something enough, you get better at it. And one day I used to do non-farm. So every first Friday, it was me on CNBC. Eventually, that was my spot. And then one day I had a really bad day. My partners hated me. So at 7:15, 7:30 number, your money number. That's where you made your money, your commission guy, right? I was doing TV for nothing, and my partners said, like, you know, if you don't call these customers, they're not going to trade. Like, what the heck are you doing up there? And I told them, I remember telling them, I said, I don't know why I'm doing it. I just feel like I should be doing it. And I did it for 3 or 4 years, all gratis. Got a little better every time. And one day I had a customer driving me crazy. So I ran up there. My mic was on. I said, man, I wish these people would offer me a job. I'm sick of the ulcers. I'm sick of worrying about customers' positions when they don't care and it's a winner. They send themselves a thank you card if it's a loser. They send a guy with a crooked nose to come and see me. But anyway, they did offer me a job. And I'll tell you what, it's been a good run. I'm a lucky guy. I like what I do, and I think that's why Ira and I get along so well. The markets are the greatest Rubik's Cube of all time, and it's our responsibility to make sure central banks don't screw it up anymore.
Well, speaking of central banks, when we were...
How was that for a segue?
How about that for a segue? Well, it was funny when we were thinking about topics, I was going, well, what should I talk about? And you just watched Rick for a few minutes, and obviously central banks was one of the top things he wanted to discuss. So we're going to continue to go with you, Rick. And you said something to me, central banks and years of misallocated capital. Talk to us about that.
I had Jim Grant on today. Jim Grant's like Ira. He's just wonderful, smart, savvy, passionate. He said, what was his exact quote today? He said, radical policy is always followed by more radical policy. The deeper down the rabbit hole you go. Listen, central banks may have had their heart in the right place, but the things they have done to markets, and Ira and I talk about this at great length, markets are like signals, okay? And the signals are distorted, and everything about it's distorted. And the Federal Reserve might have PhDs, and they might come from great Ivy League schools, but in the end, they don't understand markets. They think they can do all these things, like layers on an onion, and then at some point, they just peel it off. But they're missing something. Every time they put a layer, there's all these nodes going out. This guy's money, instead of going here, one here, this happened instead of this, and you build layer and layer. It's like a Transformer movie from Hades. And they think just because they're going to reverse this, all the misallocated capital, all the companies that existed that shouldn't have existed because interest rates were too low and they were on life supports, and all the companies that should exist that didn't, they've changed everything. And I'm not sure how it's going to turn out. Some really cool guy told me about 7 years ago that they've taken us to Mars, but they don't have any propulsion on how to break out of the atmosphere to get us back. I don't know how it's going to turn out, But my guess is that I will be there trying to handicap the whole ride for everybody in the audience.
Oh, Ira, talk to us. I mean, you write a blog that I read religiously on these topics, so let's hear it from you now.
Well, as Rick takes off, because the simple line that I started talking about, because when you read these people, and I read this stuff, this is a passion for me. This is not, when I look at the world, I'm competing against the best that there is. My whole life doing this. Most people, there's a book called Inside the House of Money by this guy, Steve Drobny, in which he talks about 8 or 9 global macro traders. So he came out to see me in 2005 because John Brady at O'Connor, John and I go way back. John's taught me a lot, and I've taught John a lot. And John had told Steve Drobny about me. And he says, I don't believe this guy really exists. There's not a guy who can exist on the floor who thinks like this. So he came out to interview me, and he said, wow. So I was honored that he wrote a chapter about me in the book, because it's a very powerful book. And but with that, you look at the world, and I would say to Rick, I say, these Fed people, they're all mathematical wizards. They are. They're all, most of them, if you delve through them, and I know because the Merck had one of the greatest of all time, Fred Arditi, may he rest in peace.
Yeah, no, he was a good guy.
I'm honored. He wrote the book on derivatives in the late 90s, taught it. Brilliant guy, MIT. And like most of the economists, he has a PhD in economics in the 60s from MIT. And Fred and I became very good friends because when I was on the CME board, he was the guy. And really should have been the CEO, but that's another story. But a brilliant guy. And we would sit and talk about some of these things. And he was brilliant mathematically. But he didn't understand the world in which the way that I saw the world. But we had a lot of respect for each other. But it was all math-based. And when you dig behind these guys like Bernanke, they were all math-based guys. Okay, great. Models are okay to me for aggregating data. But you can't make policy on them. And they sell us that they know exactly how this ends. Well, no, they don't. And CNBC and Bloomberg, since Alan Greenspan, there's been a cult of personality about the Fed. The greatest Fed chairman was Paul Volcker, for many reasons. He was great, and most people couldn't tell you one thing about him. Greenspan turned it into a cult of personality because he liked to talk in ways that made him seem mysterious, and then he would do, and this would happen. Yeah, he created the Greenspan put, so the stock markets would rally. He was quick to cut rates, and he understood that. So they hung on his every word. But if you really go back and read Greenspan's speeches, he didn't know shit about anything. I got news for you. I'm telling you, he wrote a piece in 2004 when he was Fed chairman talking about the home bias and why the dollar would not be affected because U.S. investors, and I read the piece and I go, you don't know anything, because the huge amount of hedge funds absolutely overpower home bias. Home bias meaning that the small retail investor stays close to home. We don't have to worry about that money shifting out. The ability of hedge funds and people at the CME and all the banks to leverage up dwarfs that. And he had no respect for that. And I go, you really don't know quite much. I mean, listen, he's a bright guy in many ways, but I don't think he truly understood markets. He wanted to see this through a prism. I think he understood more in the 60s when he was writing about Ayn Rand than once he got to be a policymaker. And I hold him responsible for the crisis of 2008, because unlike a lot of people, I'm taking a long way around to get to a point, but unlike a lot of people, I believe that the repeal of Glass-Steagall led to the great financial crisis. And I'll give it to you really quick why. Does anybody, are any historians here? Glass-Steagall was passed in what year? What date? July 16th. I mean, June 16th. But there was something else passed June 16th, 1933. Anybody know what that was?
FDIC.
FDIC insurance. There was no FDIC insurance. So to split the banks, the only way that they would create FDIC, which was to insure deposits, was to insure against a run of retail financial institutions, was you couldn't put the risk into the commercial banks. Same day. Not a mistake. So when Greenspan, at the behest of Bob Rubin and what's his name, Sandy Weil, with the work of Larry Summers, they moved. It was the whole move was in foot because that's why Citibank, why Sandy Weil with Sherrison takes over Citibank, puts Travelers Insurance. It was all done because they were creating this vast supermarket with the plan to repeal Glass-Steagall. That's what it was all about. But if you were going to repeal Glass-Steagall, you better damn well, anybody who opts out of Glass-Steagall cannot have FDIC insurance. Because otherwise, you're giving them a free ride. Take all the risk you can, and we're going to insure you. And that's why the community banks, this is easy to fix. You didn't need Dodd-Frank. And even Sandy Weil came out, I love these guys who do the mea culpa as well after the fact, in 2012, and he's arguing with Andrew Sorkin that they should put Glass-Steagall back in place because it was actually a pretty good law and would have prevented this. And Sorkin said, well, no, my sources tell me no. Well, your sources can tell you whatever you want, but Greenspan watched it happen. And not only did they watch it happen, they made it happen because they talked about the deregulation. That's fine. Deregulate the markets. I'm a capitalist. Deregulate them. But FDIC is the inverse part of the deregulation that allows you to take unlimited risk. Unlimited risk, because that's the moral hazard that exists. So, and it's okay. The market will react to it. The markets will do what they want to do. Because if you're a bank, let's say that Citibank didn't have FDIC insurance. What do you think they'd be paying for savings? 20%. Well, they'd be paying a market rate because we'd all know that, hey, they're taking a lot of risk. But, okay, I'm willing to ride on that concept. And if they're willing to pay me 20%, here's my money. I know that I'm running great risk. It's like buying Puerto Rican bonds at 33%, at 33 cents on the dollar. I know that there's risk involved, but I should be paid for the risk. That's what capitalism's about. Pay for the risk. And the risk takers ought to pay, but they forgot to do that. Okay, so we're to the Fed.
I could go all day with this. I love it.
I know.
I could just.
But the Fed, so Rick and I would laugh about it because they're so math-oriented, and I would say, because they like to sell themselves as rocket science, but economics isn't rocket science. So, yes, I knew, I'm old enough, most of you here aren't. In 1969, I sat with my grandmother in July and watched the man walk on the moon. And as fascinating as that was, I was always fascinated that capsule, even with all the problems that it had, could come down and they could pluck that damn thing out of the ocean without anybody dying. How did they know exactly where, they knew. The Fed has no idea where this goes. They don't, and they're finally willing to admit it. So now they're going to walk this balance sheet shrinkage back slowly, because they don't know. And that's how Rick and I would kind of laugh about it. It's not right. And yet we've put so much faith in these people because we've been sold that they know what they're doing. They're most of them are academics, theoreticians. And it's nice to play a theoretical game when you get to use, and you'll hear this phrase all night, OPM, other people's money. And they are playing with the greatest vat of other people's money. So that's the predicament in which we live.
All right, let's talk a little bit. We could go on all day with this. I want to talk about the stock market a little bit because it continues to make new highs, and there's always a story behind why we're making higher highs. Nobody ever could say hey, it's technically or it's fundamentally. It's just we just keep going up. But one of the big things right now is everyone's saying tax cuts, or that this is the market. The reason why the market continues to make new highs. What do you guys think about why, we'll start with you, Rick, why the market continues to go high? Do you think it's tax cuts? Do you think it's technicals? Or is there some other reason why you think it keeps going up?
Well, I think, first of all, we have to decide why it started to go up in the first place. Okay? So the bulk of the rally happened after the November 8th elections. I think that's key, because we've seen a lot of legislation, this time around it's tax policy. Legislation is supposedly driving the market, repeal, replace, this or that. But as the policy would start as nice frozen ice cream and slowly melt away into a puddle on the floor, what did the market do? Kept going up. It doesn't fit the narrative that pretty much the media, let's be honest here, very few in the media have any respect for this president. But this isn't political. The market's up, not because of who won, in my opinion. I think the only theory that holds water is the market's up because of who didn't win, okay? There's a status quo here. But, this is so not political, I really don't care. You know, if politicians' lips are moving, they're all lying left, center, and right. But the reality is that the status quo that we had the last 2 years of the W administration and 8 years under the Barack Obama administration didn't have the kind of policies that are going to generate growth. What they did was they overspent, and they weren't bashful about it. The fact is that Hillary might have had the backing of Wall Street, and maybe she would have done some things that Wall Street liked. Let's be honest here. Wall Street's done really well the last 8 years. You know, the too big to fail banks are getting bigger. And I don't suspect that's going to change anytime soon. But I think that the break in the status quo created a lottery ticket mentality in the eyes of investors. Okay? Merkel won, no big rallies. There's been a lot of big elections, didn't see any market movement. And that lotto ticket is that even if nothing gets done, what he wants to do may not get done, but what he's not going to do is he's not going to raise taxes, he's not going to put more regulations, he's not going to do a lot of things the market didn't like. And I think that's the only theory that holds water. Now, is the market getting excited about tax cuts? I think it is, and maybe that's part of the rally. But why do I feel convinced that even if this dwindles on and it doesn't get passed in 2017, I don't know that I see any tag days. And I think that the reason the stock market's rallying is a word that's misused. It's said so many times, but it's the teen effect. There is no alternative. You find somebody that doesn't like the stock market, okay? Fine, sell out your position. Then call the guy the next day. So what are you doing with your money? Where's he going to put it? Is he going to buy bonds? Okay? Do I want to be on the same trading card as the Federal Reserve at this point in the game? I don't think so. Commodities, maybe. But then you have foreign exchange issues. Central banks are piddling around with that as well. I don't know. I think that they created a lot of capital, and the capital's going to find a home, and digging a hole is as good as anything. But I think that the stock market underpinnings are part optimism that something's going to get done, and a lot of optimism about what didn't get done.
Ira, what do you think?
Well, you know, I agree with a lot of what Rick says, but somebody asked me that question today, and they said, is it Trump? I said, no, it's because he's taking credit for it. It's 90% still quantitative ease. We know.
Other central banks.
The European Central Bank is going to add a trillion in dollar terms, 720 euros, but basically a trillion. The Bank of Japan is going to add another $900 million. That's a lot of liquidity. We haven't even discussed the Swiss National Bank and other places. So there's so much, and money is fungible. You know, everybody forgets you live in a world. See, when Rick and I started out, there were actually foreign exchange controls. You couldn't just move money so easily around the world. Britain still had exchange controls. Money just flows, and most of you sitting in this room at a hit of a button. And it flows, and it flows, and it flows. So when the central banks are adding basically $2 trillion in liquidity, that's not, and the Fed is just rolling. They're just starting to shrink now, 10 billion. Okay. And they talk about the ECB possibly. We'll get to that later. But it all comes down to, it's all fungible. So, and it's got to go somewhere. It's got to go somewhere. And we know that economic growth, listen, for the amount of money the Fed has created in the system, we should be having economic growth nominal GDP of 8, 9, 10%. But it hasn't happened, which is why those people sitting in the Fed room are going, our models told us this was supposed to, but the models haven't projected.
Their models were right. It generated a lot of capital.
Oh,
the model was wrong as to where it would go.
As to where it was, absolutely. And we live in a financially engineered economy. Everybody's trying to just generate, and the money's out there to do it. And especially if you don't need the money, it's there. You know, if you need to borrow money, borrowing money is not easy if you need it.
But I have to interrupt you,
Yeah.
okay? I agree with that. You agree with me. But why did everything change on November 9th? Okay?
was-
The central banks didn't ramp anything up. They were still buying what?
No, I
Combined
agree.
$110 billion a month?
I agree with you, but what happened is that the fear of regulation. See, I think if Hillary had won, we would have had the next 4 years of more.
And I think that's why big banks were donating.
It-
Big banks love the barrier to entry. Build the wall higher so our competition can't even see who we are.
I agree with that wholeheartedly. So it's not that, and it's just that we're not getting the executive orders. Because what we don't realize, what we find out now, is how much regulation was created through all the different departments by executive order. And so business feels a little bit better. So it's that. And I think it's that with the money and the hope for tax cut. But as long as you ask me that, I'm going to respond to Buffett the other day. Because Becky Quick had him on, and I'm listening, and he says, he basically told you he'd like to be selling stocks here. He said that. But he doesn't because the tax cut. Now, personally, as an investor, and I own, throughout all of this, and my wife's sitting here, we own more stock than I ever have in my life. Because I have so much risk in my life, I don't need to, that's just not the way I operate. My savings is my savings, and we go from there. But we probably have more invested in stocks. And I've never understood trading stocks on a tax basis. My wife's a CPA. I'm not an accountant. My eyes glaze over. But Buffett's talking about he doesn't want to sell now because of the corporate tax cut from 35 to 25 possibly. Well, wait a minute. That doesn't bother me. If I've had stocks for 2, 3, 4, 5 years, and if I sell out with a gain, I'm paying 20% long-term capital gains now. What is that 10% differential going to do for me personally? Minimus. By the time it all falls out, if a company has 1 billion shares, what's going to be the real gain to me personally? And if everybody, and Buffett said he's holding out for that. So, I see the power in this rally, and I've long more stock in not in my trading account, that's a whole different world, but in my personal investing account, in my IRA, in my SEP account, in my wife and I, in our savings account, we have more stock than we have. But I'm a skeptic, but I also understand the power of this cheap money.
So what gets you to sell stock then?
Huh?
What's the catalyst to get you to start to sell some of that stock?
Well, Anthony, we've talked about this, and I know I enlightened you more than you knew about it. I'm a big yield curve guy.
Yep.
That's the one guarantee. All the wise asses in the world will tell you, the stock market's predicted 10 of the last 6 recessions. Okay, I get that. But not the yield curves. Yield curves are absolutely beautiful. In 2007, the US 210 curve inverted. Most people don't realize that because the Fed was busy raising on the short end. Credit was out there. People were getting nervous. That curve inverted. The only thing I can't tell you, and there's a lot better mathematicians here sitting in this room than I am, I can't tell you the timeline of when that's going to take place because the market did rally another 4 or 5 months after the inversion. But the inversion was a signal. So I look for my signals. Yield curves are very important for me. When the European debt crisis of 2012 and Mario Draghi's famous comment of whatever it takes, and I actually was on with Steve Leisman that morning, July 25th, 2012, by happenstance. I drew the short straw for the 5:30 in the morning hit, and that's when he came out and said it. But Leisman and I were talking about it. He says, well, what's the problem here? The European yield curves were flattening dramatically because everybody was afraid of a solvency issue. Not a liquidity issue, a solvency issue in Europe. And so they were actually running out of the 2-year notes. And if you looked at Italy, Spain, Portugal, even Germany, those curves, the 2-year yields were rising dramatically. They were up over 7%. So those curves had flattened, and that was the signal to me that something major was going on. So I look at yield curves. And right now, Rick and I have talked about it quite a bit because he's really pay attention when he covers it because he knows this very well. But on the 210, and I have different ways of looking at it, but I'm using the 210 because that's more of an investor's curve. A 530 I view as a more speculative curve, but the 210, and if you look over the last 2-3 years, 73 basis points positive, which is still pretty rich. That's not flat by historical standards. If I asked you, I'll ask the audience, if I go over the last 200 months, 200 is quite a long time, what do you think the average of the 210 curve is?
The last how many months?
200 months. It's a long time, 20 years. Or it's about 95, 98 basis points. I haven't checked it, but so we're not really that flat for all the people we're talking about. I heard somebody talking about yesterday, the bank stocks are up because the curves are steepening. Curves aren't steepening. The 210 today was at 86. It ended on December 31st. On December 31st, 2016, it was 131. So we're fairly flat here. The curve is flat, and it's not steepening, and yet bank stocks are a lot higher anyway. So when they try to sell you, that'll work at some point, but not necessarily. So the yield curves are very important for me.
Yeah, no, you definitely have enlightened me on that. You said the 210, 73 basis points. I continue to get asked about it on Twitter.
Times?
It just keeps hitting it and bouncing. So, yeah, definitely something to keep an eye on. Now, I want to talk a little bit more about the President Trump and talking about the Fed chair. He's got a short list now from his advisors. And Kevin Warsh right now is the favorite. We got Yellen there. We have Gary Cohn. We've got Jerome Powell. And I want you guys also to comment on Jeffrey Gundlach saying this. And I know, Rick, we talked about this earlier from Double Line Capital. He said that Neil Kashkari will get the job. So I want to know your thoughts on who you think will get the job and also who you think should get the job. We'll go to you, Rick, first.
I think John Taylor should get the job, but he won't. Actually, I think 1/3 of the job should go to Dell. I think they should use an algorithm. I think in this day and age, certain aspects, I'm completely serious, certain aspects of what the Fed does, the human emotion, this notion that, they always want to be Santa Claus with respect to lowering rates. It's never symmetric with regard to tightening and easing. So I would like Mr. Taylor or a computer to do a good chunk of it. But most likely, we're going to end up, in my opinion, with
Warsh.
And
what do you think how do you think the markets react to him?
I think the markets have great respect for Warsh. I think that some of the things he's written, some of the speeches he's given, I think he's going to take a more balanced approach. I think when it comes to Mr. Gundlach's pick, the head of the Minneapolis Fed, once again, I'll have to allude to Jim Grant today. Listen, this administration has committed many faux pas. We all know that. I think they have good policy, but a lot of times I think loose lips are just horrible in this scenario. The president has expressed quite clearly that I like low interest rates. This isn't what you want to hear. You know what I like? I like free markets picking what the interest rates are. And I like the Fed to be a little nudger. They've turned into like this monstrosity. In 1913, when they created the monster from Jekyll Island, they all put on mustaches and disguises and jumped on a train to go create it. Right from the get-go, there's something wrong with that picture. Okay, but that's for another day. The Federal Reserve and the ECB and the book that Ira wants you to read really is a must-read. These guys have turned themselves into like these Iron Men. So I would like to see this tweaked back a bit, and hopefully we'll learn from this experience. I really don't think there's any way that Janet Yellen gets reappointed. I guess the other good news is that Larry Summers' name didn't come up.
Ira, who are you thinking is going to get the job, and who would you like to see get the job?
Well, let me, Art, in the blog I wrote about that it wouldn't be Cohn because, and I'll step back as to why, and Art Cashin actually, who gives me shout outs at times, and that's very gratifying because I have a lot of respect for Art. And he picked up, he says, yeah, I think that's right. Because, see, all these people are out selling it. When Steve Leisman comes on, he tells you my sources. Yesterday, he said, no way, Kashkari. No way. My sources sit in the way.
There's something I agree on with Steve Leisman? Holy cow.
But let me give you the other side of that. Neil Kashkari, if you follow his career, He's kind of like Tim Geithner in this regard. He keeps popping up, which means that he has a guardian angel somewhere.
Benefactor.
He has a benefactor. Somebody somewhere is promoting him forward, just like Bob Rubin did with Larry Summers. I mean, Larry Summers was Larry Summers. You know, if they gave a Nobel Prize for eugenics and economics, Larry Summers would have a Nobel Prize because his uncle, I don't know if you know, his uncle's Paul Samuelson, and his uncle on his maternal side is Kenneth Arrow, two of the great Nobel Prizes in economic history. So he comes from a very good bloodline.
Brilliant man.
Yeah, he is brilliant.
Just don't want him to run the Fed.
Right. So in 2013, Leisman said it was Summers for sure. His sources told him. And I wrote in the blog, you can go see it, I said, no chance, because there's another wrinkle in this. Lizzie Warren, whether you like her or not, and when it comes to finance, Elizabeth Warren knows her stuff. She knows. She knows her things. She will not, Gary Cohn, that was why he wouldn't be Cohn, because she has a blocking, and it's just not her. She's got David Vetter, a Republican from Louisiana, and Sherrod Brown from Ohio. They were going to block Summers, because Summers was the lock for 2013. Everybody said it, you know, but there was no way he was going to get confirmed in that Senate. No way. And there were Republicans as well. It will not be a Wall Street guy. I believe that. I believe that's a detriment, and especially Trump. Trump cannot go to Wall Street. Whatever base he has that supports him will be very, if he picked a Wall Street guy like Gary Cohn, so I believe that's off the table. Warsh has good, I've read Kevin Warsh's pieces. I disagreed with him when he was a Fed governor on some pieces, but he's very bright, and he's out at Stanford, where John Taylor is. You're not going to get John Taylor because he's just too doctrinaire. And Trump cannot take somebody who's doctrinaire. He'll want to have some influence. But Warsh is a strong voice. I think that would be a very good pick. But don't discount Kashkari. And I'll tell you why. Because Gundlach was an early Trump guy. You know, I don't know if you remember, in July and August of 2016, Gundlach was out all over the wires predicting a Trump victory.
Yeah, he didn't just wake up one day.
That's
wow,
right.
This is what I think it's going to be.
So I have a feeling that he may be a little mouthpiece into Trump. You know, he's a very bright guy. He's a good guy to have. He was definitely a supporter of Trump. So I would agree with Rick. It's Warsh, but I wouldn't totally discount Kashkari, because guys like that who have benefactors just seem to, because he keeps popping up.
Let's just say that Kashkari does get it. What impact is that going to have on the markets right away?
Bye, Mortimer, bye.
All right, let's move on. Let's play a little game here. I'm going to pick 7 markets, and you're going to give me one of the following 3 answers. Buy the dips, sell the rips, neither. I have no idea where it's going. And we're basically looking for the next quarter, right? So we're into the 4th quarter. So let's move on with some markets. Let's start off
I'm
with...
glad you're doing this to Rick, because he does this. And he's got a little payback now.
Yeah. All right, good. All right, so we'll start off with Rick, and we'll start with the big boy, S&P.
Higher.
So buy the dips, Ira.
For the next quarter?
Just for the rest of this year.
For the rest of
The trader side in you right now.
I'm a seller.
So sell the rips, and you're a
Buy the dips. I'd buy the dips and buy the rips.
Bid to the moon. Quick question. Why are you a seller?
Well, because on some valuation measures, and I wrote about it the other day, I have a valuation measure that I watch. It's simple. It's such a simple metric. You're going to laugh at me, but it's the S&P bond. Just a simple futures to futures. And I've watched this for, I can tell you exactly how long, 25 years. And it's been a very good metric, where it's held and where it's on 200 moving average, and it's just simple division. I take the S&P divided by the bond, and it gives me a relationship, because the S&P still have to be measured to something. Something has to matter. Things cannot exist. I'm not one of these people who believe that valuations exist in space, and that's the way it is. But I also believe that in 1999, and people laughed at me with when the NASDAQ valuations were crazy. But I'll tell you this, it was interesting because in December, I keep this on a monthly chart, And December of 1999, it had made its all-time high up until the end of September. That ratio had held for 18 years, almost 18 years. We finally closed a month above it, and I can tell you what it is. It was 1634.5, and Judd Hirschberg is here. He'll nod his head. That's exact. So 1634.5 was the all-time high going back to December of 1999, which was a critical point for traders because we know what happened in 2000, the end of the dot-com boom, everything blew up in the stock market. It was the end of the boom. So that became a significant level to me. I'm taking you through how my mind works. You can agree with it, not agree with it, doesn't matter. I don't need, as I say, I don't need your validation. I like the discourse. I don't need validation. Pushback and dialectic is far better. I'm an old Marxist. Give me dialectic. I don't care about anything else. We'll get to some modicum of what is right or not. So since I wrote about that, which was on September 29th in the blog, I put it in that weekend blog, that thing has moved. Wow, it's enormous. The S&Ps have been up. Now today's, what day is today? The 5th. So all week, it's been a huge move. Once we finally got that close, and it had respected that close. We had got up there several times over the last 18 years, but could never close above it. Now we did. So I'm going to use that as my sell point. That's what will, if we get under there, I may take a little shot and say, okay, you know what? It ran its course. The market has a huge valuation relative to interest rates. Even at a zero-bound interest rate, there might be something here. I don't know. I'm not risking, believe me. There's no trade where I risk everything, but it may be worth looking at.
All right, next market, we'll go right back to IRA because we're going to go with gold. Buy the dips, sell the rips, or neither. You don't know.
Buy the dips.
Buy the dips.
Buy the dips in gold. Bonds. We'll go 30-year. Yeah, 30-year
30
bonds.
year?
Yeah.
I'm really neutral on them because until I know what the ECB is going to do, I just don't have.
So ECB is going to be a catalyst. Something to watch
They're a
for.
neutralizer to whatever.
Okay.
If you're bearish, you can only be so bearish because they're in. And again, money's fungible.
He said the next quarter. Mario Draghi isn't that brave. Give me a break.
Okay.
There's no way. He's got to
Higher.
go through the talking game first. Yeah.
Higher.
So okay, buy the dips.
Sell them looking for higher rates. So
Oh, he's looking for higher rates?
Yes.
I'm neutral. They're
Okay.
going they're steady to lower.
it's going to be like watching paint dry, but I think rates will go higher. I mean, geez, we had 7 closes in a row within 3 basis points, 4 basis points, 7 sessions between 231 and 235.
I know you had talked about this the other day too on CNBC. It was really good. Euro.
October 26th is the next big ECB meeting. Okay, so this will come within the quarter. So I would say the euro, you want to sell the rips, but you want to keep your powder dry for a while.
IRA.
Well, I'm going to give you, I'm a seller, but I'm going to, not right here. That 120.40 to 123 area in the euro, huge. If you go look at a chart, it's really easy to see to where it goes. It goes back to May to July of 2012. The 120.40 was the low until Draghi made that whatever it takes, because the euro was falling apart because they were worried it was an existential crisis for Europe. That was the low. We got up into this area. The high that week, I think, was 123. So I'm a seller against that area at this time.
So let's just go to the opposite side of that, the dollar, U.S. dollar.
Well, you know, again, I'm going to refer to the blog, but in February, I got bearish the dollar when everybody was bullish, everybody, because of Mark Fields, who was the CEO of Ford when he came out of that meeting with Trump. And he said this right to the media, right when he walked out, he said, currency intervention is the mother of all trade barriers. Trump wants a lower dollar. It's part of the Trump mantra. I believe Wilbur Ross believes, because it's just a negotiating tool.
So then he's going to point Kashkari for sure.
Yeah, well,
I mean, there's your weaker dollar.
so, you know, I give you the euro, one of the euro. Because I'm bullish gold. I'm bullish gold against all currencies at some point. It's not an easy trade to make, and it's a trade. It's not an investment. So when you get a nice profit, take it and look for it again, because they make it very difficult It's a very, everybody in the world's trying to talk their currency down. When you read when the Reserve Bank of Australia, in their press release on interest rates, they talk about the Australian dollar being too strong. The Swiss National Bank, currency is too strong. The euro, the currency is too strong. The British pound, Canada. So everybody's trying to get a lower currency. So, it's hard to like anything. I like the dollar the least because I think the U.S. has some structural problems, major. Not that the euro doesn't. That's a whole nother.
So, Rick, what do you think about the dollar?
Well, the mirror image of the euro. I think the dollar is going to creep up, but I don't think it's going to have its finest move until we get closer to the end of the year. But all in all, I'm a buyer on dips.
All right. Next, we're going to move on and talk about oil. Shout out to Shy Girl in the audience. Shy Girl, buying the dips or selling the rips or neutral for the rest of the quarter? Huh?
Oh, yeah, absolutely. Yeah.
Structurally, I'm a fundamental bear if we're talking long-term market.
Yeah. Yeah, we know she's a day trader and she might change her mind tomorrow, so we know
all right.
we don't hold her accountable. Yeah, exactly. So
If we're talking, 2 years, 5 years, 10-year view, then I think we're going to see depressed oil prices.
yeah. Ira.
I think structurally, it's a bear, but the geopolitical factors keep the bears on edge, and rightfully so. There are things going on besides hurricanes and things in the Middle East. And if you pay attention, who went to Russia yesterday? The Saudi sheik.
Hillary?
No. For the very first time. And if you don't think that things are afoot, pay attention. A Saudi sheik going to Russia.
Rick.
Better than that. Sovereign wealth funds are created in the Middle East. Give me a break. That says it all. It's all you need to know. Okay? The frackers in this country changed the world. In the Middle East, their great days are behind them. Oil is going to slowly drift lower, but it's going to be in a range of 35 to 57 for the next 5 years.
Shy Girl agrees, for the record. Now, last one, probably the one we have the most questions about and know the least about, Bitcoin.
Limey, what are you doing there? I find Bitcoin fascinating. But let me preempt this. I'm more interested because there's a guy back there, David James, who's really taught me so much about blockchain. And I'm more interested in the technology of Bitcoin than I am Bitcoin. Because I know that governments hate competition. Okay, that's what bothers me about Bitcoin or other of these coins. But the technology of blockchain, I'm an old guy, and to get these moves, to understand them, it really takes me a while, but I'm very fascinated by that. But as far as these alternative currencies, again, governments hate competition, and anybody who's long Bitcoin, it's fine, it's working, it goes up, and it's not for me, because all it's going to take is one terrorist attack that is supposedly funded by Bitcoin, and watch what happens. You already saw the Chinese put their foot down in some regards. So that keeps me, because when I see a currency is, and some people have actually gotten this right. A currency does two things. It's a means of exchange and it's a store of value. Bitcoin, for a very limited part of the world, is a means of exchange, but it certainly isn't a store of value. Not when it drops 16% in a day and then goes up 18. It's just not. It's fun to play with if you're long or, you've been buying this stuff. For me, you know what? I could find other ways to get my jollies. Not for me, but I'm much more interested in the technology of it.
Rick, what do you think about Bitcoin?
There's a sucker born every minute. Now, listen, this is one of the few things I might agree with Jamie Dimon on, so I won't make a comment as to the direction. Listen, to each his own. I just find that it's not my cup of tea.
Yeah.
I will say the biggest thing that scares me is that Ben Bernanke said he doesn't understand gold, but he understands Bitcoin. Now I'm nervous.
Yeah, we really could end there. I mean, I don't know
Yeah.
that you could come up with a more profound thought.
Well, we're ready for our rapid fire segment, guys. So we're going to go through a few questions here. Not all are going to be pertaining to trading. It is a night out in Futures Radio Show, so we're going to have a little bit of fun. But the first one is very interesting to me, and I can't wait to hear this answer. What trader has influenced you the most, and why? We'll go with Ira first.
My mentor in life, my trading life, was a man named Leonard Feldman, who passed away in December of 2015, and he taught me the basis. And I know I was talking with Mike before. If you don't know about loss taking, you cannot be in this business. As he would pound into my head every day, keep your losses small. You can always get back in the market. Keep your losses small. Always get back. Live to fight another day. And as you know, and as would have been said, there were all these great teachers at the exchange, and they would tell you, if you come to the trading floor with a big ego and a big checkbook, you'll soon leave with a big ego.
Rick, what trader has influenced you the most, and why?
A guy named Tom Lucian Baldwin, one of the biggest bond traders of all time. In 1985, he traded more bond futures than Goldman Sachs. And not necessarily because he was a really wonderful guy. I didn't really know him that well. But what he taught me is that market logistics matter. Okay, I wish everybody that ever served on the Federal Reserve could have studied Tom Lucian Baldwin. Because on any given moment in the structure that existed for most of the 80s and 90s in futures pits, he could pretty much get the market to do anything he wanted in the short term. And it really gives you an education into, you can look at fundamentals, you could look at charts, but liquidity, where it comes in, and the clock all matter a lot.
Ira, if you could be long any market from now until the end of the year, what would it be?
My favorite play right now is what you're asking me.
Yep.
I'd like to be long silver and short gold.
Well, the
As
next one
much
was
as-
going to be short, so you answered them both. Well, that's
Okay.
good, so-
Well, no, because it's
Oh, so that's a
a
trade.
ratio that
Oh, a
goes
ratio.
back, thousands of years. And I'm looking at this, and I'll explain to you why. Silver is probably the most massive underperforming market relative, especially because of what copper's done this year. So if you believe that copper's up because of global economic growth, because there's a global growth story, there's never been a metals market rally where silver hasn't led. So I'm looking for that. Believe me, my stops are very close, as I say. I still take some, but that's the one play that I'm looking for. The ratio right now is about 76-1. I'm looking for a move. If the copper move is real, based on real underlying economics, I'd be looking for a move from about 76 down to about 68. I think the 200-day moving average is 73. I'd like to see a test of that before the month is out. And that's a trade that has my attention. I'm not in it, just playing with it, but
Okay. Rick, what do you think?
I have three answers: the S&P, the Dow, and the NASDAQ. And I'm not saying I think they should be there, okay? We can have a lot of reasons why they shouldn't be.
One of
But
you guys
I
wants to
think they're going to
treat it
get turbo thrusters going into the end of the year.
Let's talk about which market you'd like to be short between now and the end of the year. We'll go over you, Rick, first.
The pound.
where I would really be comfortable short. I would like to tell you that I'd like to be short the 10-year or the 30-year because I think the curve is going to steepen.
That would be your favorite one, though? He wants your
your
favorite
favorite.
one.
Yeah, that would, because I would be short the long end on a spread. But, a lot of my trades are relative.
He didn't jump on my selling bonds for the next quarter.
I would be looking for the long end because the market's going to have to test the Fed resolve. But we're going to have to wait till the October 26th because they're all expecting Draghi to announce a recalibration. But I will tell you right now, the recalibration will be from $60 billion a month to $50 billion because when he said recalibration of the ECB, if you recalibrate based on the currency appreciation, he can drop it 10 billion,
Still do
and
the
it's still the same goddamn number. So that recalibration really caught my eye, because Mario Draghi is the biggest bullshitter in the world. This guy can BS. I'm telling you, I've seen more honest three-card Monte games being played in Central Park than this guy's dealing. But he gets away with it. But watch, that to me is going to be the recalibration on October 26th. And then I'd like to get short the long end
Okay.
on a spread basis.
A fun question now. Now, maybe you're not a golfer, Rick, I don't know, but if you could pick 3 people, dead or alive, to play golf with, who would they be?
Ayn Rand, Frank Sinatra, and Ira Harris.
All right, Ira, are you going to include Rick in your...
No.
Okay.
I've heard the way he hits the ball.
I don't golf. I decapitate worms, but I have fun.
So who are your 3, Ira?
Who would I like to play golf?
Yeah, dead or alive, 3 people to be in your foursome.
Wow, Anthony, these are really tough questions. My wife I would play with, but she's alive. She'd be the 4th, so I got to pick 2 others, because we always have good conversations. Who would I like to play golf with? I'd love to play golf with Arnold Palmer, because I could yuck it up with him. I think he's a guy you could really yuck it up with. And it's not even Joseph Schumpeter, the economist. I'd like to play golf with him. I'd like to spend any time with him, because he's, the Economist magazine named him the top economist of the last 100 when they did that a few years ago, and he was a Rascallian and a very dapper guy. So I'd kind of like to spend. There's things I'd like to talk to him about directly.
All right, Rick. What has a greater probability by the end of Q1 in 2018? The Chicago Bears winning the Super Bowl, or the S&P having a 10% correction?
There's no C? There's only A and B on this one, huh? Oh, my God. Well, listen, the Bears, there's no way, so I'm going to have to go S&P 10%, but I don't believe it. But, I mean, if those are my 2 choices, that's what I'd have to say.
Hand Ira the mic. Ira, what do you think?
Well, the Bears are no chance. But I would frame it a little different, Anthony. I'm going to come back at you. I would frame it this way.
It's all right.
Rick has to turn my microphone.
No,
You're good.
yeah, it is good.
So I would frame it this way. Is there a greater chance of a 3% rally from here in the S&P or a 10% break?
You changing my questions on me now,
Yes, I
Ira?
am. Yeah,
Guy's a handful interview,
It's
isn't
a lot of
he?
work, man.
Because the Bears are, come on, that's not a possibility. So I would say there's a greater chance of a 10% down before a 3% rally from today.
Okay. We'll go back to Rick. If you could be a member of any band, what band would you be a member
Oh,
of?
that's easy. My buddy Billy Gibbons, ZZ Top.
ZZ Top.
God, what is wrong with you?
Ira, what about you?
Catch me at a weak time. There's so many good. Oh, I want to be in Jethro Tull.
I just saw him. He was horrible, but they used to be good. I saw him at Chicago Theater. I didn't recognize the songs.
Well, final question for tonight, guys. We're in Chicago. You guys are Chicagoans. Who's your team, Cubs or Sox?
God, the Cubs, of course. We only have one team in this city. Come on.
Ira? We all know.
I'm a lifelong Cub fan.
That's right.
You should
I'm
see
a
his
disease.
seats.
Yeah. Well, everybody, that wraps it up for tonight. Thank you so much for joining us.
Hey, we have to thank Anthony here. Big hand for Anthony.
Thank you, guys.
And let me pick up, because, see, this is why I love being interviewed because I do work with you, because it's a pleasure to be with professionals who really know, because you're only as good as the questions that come at you. When I get interviewed, I'm only as good as the questions that come. And you guys, it's like a pleasure. Rick, we cover more ground. And Anthony, and we never prepare. Do we ever
Never.
prep?
Never.
Have we ever prepped
No,
once?
you and I get more syllables in 3 minutes than any other 2 humans alive.
There's no teleprompters, and it's just professionals talking to professionals,
Listen.
and that's what makes it work.
You bring a great point. I have to finish this out. Everybody in this room knows people that are so into sports that they just know every possible statistic known to man, okay? So if you need to use a teleprompter to talk about the markets, you don't know the markets.
Yeah. All right, we're going to open up to questions now in the audience, and then we're also going to be able to go to using social media here, using the hashtag NightOutFRS on Twitter. So we'll start here in the audience, and I'll be taking a look at Twitter on my phone. We'll begin with this gentleman right here. First question.
Wait for the mic.
Thank you. I thought that was a really interesting discussion generally, but I really liked what you said about the central banks. And I remember that in the old days of the 70s, like you were kind of talking about, that inflation was a much bigger problem and a much bigger concern. And with all this quantitative easing, is there inflation coming? And I've sort of felt personally, this was my theory, is that in the Obama era, there was so much unemployment that there wasn't inflation because of the unemployment. But if employment picks up, are we going to see inflation?
There's a lot of inflation. It's called the Dow, the S&P, and the NASDAQ. Financial inflation. That's what we've created. In terms of the traditional inflation, inflation is the Siamese twin, in my opinion. Milton Friedman had wonderful ideas, but I think those days are gone in terms of what a currency really is now. I think inflation is a Siamese twin to growth and productivity. Okay? If the central banks want inflation and they want higher prices, they're going to have to get better productivity and better growth. Because without those two things, you're not going to get the upward price pressure. And considering the debt levels that we have, it's going to be very, very difficult to stoke the kind of inflation. And I don't even like to use that word. And we both, all of us actually have a friend named Peter Bookvar. He's on CNBC a lot, a really good guy. He doesn't even use the term inflation anymore. He says, you really understand it better if you think about saying cost of living. Why do central banks want everybody's cost of living to go up X amount %? And it's so arbitrary. In 1977, when they sanctioned the two pillars of the Federal Reserve, you know, it's price stability and maximum employment. I don't know. Has anybody looked at CPI over the last 8 years? If that isn't the very definition of stability, I don't know what is. I think this 2%, and it's arbitrary. They have 2% in Europe. They have 2% here. I mean, these are two economies that have never been calibrated that way. So I guess to answer your question, I don't believe the unemployment rate when you have 100 million people that can work that aren't working. And I think that the Fed actually believes that, and that's part of the reason they've done the wrong thing at the wrong time for so long. When you get 3% growth, you're going to get inflation. And when you get it, central banks aren't going to know what to do with it.
Other questions in the audience? Oh, you want to keep going, Aaron?
It's a very good point. In the 70s were different. If you've watched the Vietnam series, anybody watching the Vietnam series? It's interesting to watch it. As I was talking, it's really angered me because, again, when you watch the Vietnam series, and I'm old enough, and I was an anti-war demonstrator and damn proud of every minute of it, I have to tell you. I have no, when I listen to these politicians who apologize for the, like Bill Clinton, it always upset me. Hey, it was the right thing to do. But you watch a group of the quote-unquote best and the brightest who made these massive decisions, and they were wrong. They were wrong. And the whole time that they're doing them, they're uncertain about it, but they keep going on anyway. Well, that was why we got all the inflation, because Lyndon Johnson was funding the war on poverty, right, which was a great thing. We had massive social change, civil rights. These were really good things, but he bought off all that civil rights with military spending. And he had a very complacent Federal Reserve. So complacent that in 1971, when Richard Nixon's president, he sees the way this is all working, he makes the line, we're all Keynesians now. Because once he understands how you can prime the pump and keep the money flowing to get elected, and he wins in the greatest landslide in the history of the United States, 1972. Yes, he had a weak, but the economy was booming, and we paid for it with the inflation. Everybody says, who comes on, well, these people were all wrong. There's no inflation. As Rick points out, we have asset price inflation, and it's global in nature. How do I know that? Look at the amount of debt. The global debt is higher now than it was in 2007 and 2008. Because the money goes somewhere. You have emerging market countries who are borrowed to the max in dollars. So when the Fed, this is a big problem for the Fed because as they raise rates, you got to pay back debt. So the cost of that is going to, but the reason that we didn't get it, because what people forget, the Fed also, Congress also gave the Fed the ability to do something that they never had before when they did all this quantitative easing. Interest on reserves. Because when banks used to park money at the Fed, they never got paid interest. But the Fed knew that they were creating all this liquidity, and they weren't sure how it would act in the system. So they started paying interest on excess reserves. That's what's called interest on excess reserves. So because there was no borrowing going down, because Richard Koo, and he's the lead economist from Nomura, he does great work. He wrote the piece about the balance sheet recession, phenomenal work. People were paying down debt. They weren't borrowing. But all that money was sitting at the Fed, and the Fed was paying the banks interest on all the reserves that they were created. Ben Hunt from the Epsilon theory, who's a regular read for me, he's a really bright guy. He has a theory that once the Fed starts shrinking its balance sheet, inflation's going to jump dramatically because these reserves are going to stop being parked at the Fed and they're going to actually start circulating in the system. I'm not sure if he's right, but it's an interesting theory. But we'll see what's going to happen.
A question from Twitter. If with so many Americans depending on 401ks for retirement, doesn't the Fed have to help the markets? Rick?
See, I even hate the question. I mean, this is the problem. We've got a nanny global society here. But it is a valid question because, see, the central banks have committed such sins that when the stimulus recedes and they put the fire hose away, it's so crazy. There's a geranium 40 miles away, and they want to spray it with this fire hose, and all this liquidity before it gets to that plant just gets wasted. I just don't. What was the question again? See, when I start thinking central banks, the gears get hot.
Well, the question, let me go back and read it exactly so I get it exactly right. The question is, if with so many Americans depending in 401k...
See, they're going to end up... Yeah. See, the problem is that they have to. Because the distortions are so large, and the game plan was to put Americans in that trade. That's the trade they wanted them to do. Okay? They wanted the money to move into the equity markets. They wanted to create this wealth effect. So if the distortion recedes and people can't retire, I mean, we all know how that's going to end. Yes, there's going to be a responsibility there. I think it's a bad thing, but the moral hazard has now been metastasized in the global financial culture.
Any more questions from the audience? James.
So I have a question about 2008. And what I don't want to do is sort of relitigate everything that, how the easing of money and interest rates and the Community Reinvestment Act and investment banks and CDOs and synthetics and all this stuff. My question is, when it really was imploding, when it was really happening, you were all there, when Kramer's going nuts, the whole markets are seizing up. GE or McDonald's couldn't get credit. AIG is failing. The whole world runs on insurance. You can't, have a super tanker go anywhere. You can't open up a playground. Everything just seizes up. And so my question is, I really want to contain this because I want the answer. And I think I know where you stand. You are against what central banks do, and I understand that perspective. But the alternative is my question. What should they have done? You have this situation, without being long-winded, that what is the alternative? If you tell me the markets will decide, they'll figure it out, they'll sort it out, everyone will be, McDonald's couldn't get credit. You can't, we know all these facts. So what I'm asking is, and I'm honestly asking, because you guys bash central banks and we go through all this stuff, what should they have done? to get out of that, because it looks like it's pretty good. And the one thing I will agree with you, we don't know how, when they unwind the Fed.
We don't know.
Jamie Dimon, they say, it can go one of two ways. It can go well, it can go poorly. They did this, they put it on, they put the trade on when it was a catastrophe, and now they're going to try to ease off when it's not. So it could go well, but my question is, what should they have done?
It's a good question and a fair, and Rick and I have argued on television because we disagreed, because I believed in QE1. I think Rick would tell you now that it was the right thing to do, but certainly not in that real time, because I will tell you this, the day he went on that famous rant heard around the world about the Tea Party, I came down to the floor. I was sitting up watching the TV. I come running down the floor, and I ran up to the pit, and I said to him, I hope you enjoy your audit. And he laughed, but that was Rick talking. So we had to talk. And I agree with QE1. QE2, QE3, and everything that's followed.
The twist?
Yeah, I disagree with that vehemently. Because the point that you make, and if you follow Bernanke, he told you, because Bernanke's work was about understanding 1937. I tongue-in-cheek say that they should change the name of the Washington Redskins to the 37ers, because that sets the mindset. And I was there when Bernanke told Milton Friedman, I'm sorry, I wasn't there, but I was with Milton Friedman at his 90th birthday, thanks to Leo Mohammed. But Ben Bernanke famously said to Milton Friedman at his 90th birthday party that we understand and will never let it happen again, talking about 1937. And I agree. The QE1 was important to prevent the massive liquidation of assets. I believed it at the beginning. I thought that was the right route, especially with would have been a real functional TARP rather than the baloney that we got. Of course, because once the politicians played with it, you got nothing. But to prevent the liquidation of assets was absolutely important. And my view on that, and I think from the way you're asking that question, was we couldn't go into 1930s. This country could not take 25% unemployment again. Rick and I will disagree with that. We don't have the social fabric to do it.
I'm not arguing with that.
No. Well, and so I said, yes, QE1 from the start, right thing. I never understood QE2 or QE3, not for the life of me, because he never gave it a chance to really do, and now they've piled on these massive amounts that they don't know how to extricate themselves from. That's my whole point.
I don't bash central banks, okay? I talk honestly about them. Why should a group of people that are unelected get to control what's in your wallet to the extent they do? It's reprehensible. It's financial repression in every way. I didn't disagree with the asset-backed purchase program of the Fed. I didn't disagree with their commercial paper. They did good things. And between that and Sheila Barrett, the FDIC, okay, they could have made it so the average guy's money was safe, but they needed to let a lot of institutions fail, okay? We have changed financial culture forever. Do you think they're not going to do this stuff again? Do you think the next crisis they're not going to do quantitative easing again? Do you think in the next crisis they're not going to bloat their balance sheet again? We've changed everything, okay? Listen, there is a certain religion about failing. The only regulation that works is failure. All the rest of it is meaningless considering what governments will do to protect investors and markets. They did a lot of things right, but I would rephrase the question. What do you think the world would have said if Ben Bernanke and Mario Draghi and Carney and all these people, and they weren't all there from the beginning, but in 2007 when this happened, they looked the world in the eye and said, but we'll still have mediocre growth 10 years from now. Do you think they thought it was 10 years? And it's not going to be 10 years. We already lost a decade. It's going to be more. I don't know. When I get lost and I go an hour in the wrong direction, you can't get back to where you need to be in 5 minutes. It was a horrible precedent. It changed the world. And you can put any amount of regulation you want. The people on Wall Street are smart. The computers are smart to get around it. You don't get around failure. It sends a message. And the people that come after you will behave differently.
So Rick and I disagree about, because I was opposed to mass liquidation, which was the alternative. We were going to go into mass liquidation of assets. You know, you
So
look at.
what, we're going to deprive our kids of buying things at a realistic price?
No, there's truth to that. But the social and political ramifications of it are an expensive price to pay. So the first round of QE, but you put, as Rick says, a lot of power into hands of people who have a terrible history of forecasting. You know, in 2000.
No, they have a 100% record. They've never seen a road hazard and let you know before you got a flat tire, ever.
In 2007, Ben Bernanke said that the housing crisis was contained. Well, you know, you've given them an awful lot of power for something that was so obvious, and it was obvious. People say they didn't see it. Forget about it. You can read. I can go.
Greenspan
one
gave a
after
dozen
another,
speeches talking about credit being overextended.
They started seeing it. They didn't understand the shadow banking market.
No, they didn't. They still don't.
Which was also created by too cheap credit from 2001 to 2004.
Why do you think all these people are stuck in Puerto Rico bonds? Because the Fed makes them reach for return in ways that are illogical.
And all that piles on, and when it's compounded, and it's leveraged in ways that they don't even understand.
I love central banks, okay? This is what they're supposed to do. They're supposed to do this, okay? They're not supposed to be Iron Man.
And the discount window was meant that if you were in trouble, you could bring your assets to the Fed, and they would lend you. You know, go read the original theory from on Lombard Street. You know, the famous book by Walter Bagehot. You know, that's what it was. That's what central banks are. They're there to provide liquidity in times of crisis, systemic crisis. Not for any. See, Greenspan really ruined this. Let's go pick on him again. Long-term capital management.
God of monetization.
The worst decision made in mankind was bailing out long-term capital. And I've argued with Myron Scholes directly, and I'm not name dropping. Again, I was on the CME board with him, and we had enough conversation about it. But he was too quick to bail them out, which set the precedent. And you know what? The best thing for capitalism was for long-term capital to go under. That would have taught a grave lesson. They didn't go under. And that set everything in motion.
Well, we're out of time, guys. This was fantastic.
No, we
I feel
can't
like
be.
we could go.
We
We'll
can't
go
be.
forever.
No,
All right.
we
They-
can shift the class.
See,
Do you guys-
I get
do we have
2.5,
more
3
batteries? 'Cause
minutes.
we might need
you
them.
give
We're
Byron
getting
this much
close. I
time,
think we're
we'll
getting
keep
close.
going and going. You're the
Guys, thank you so much for coming on. Everybody, thank you for the questions. Thank you, guys. Thank you for listening to Futures Radio Show. If you have any questions or comments for myself or my guests, please visit futuresradioshow.com and sign up to be a premium member for free. If you enjoyed the show, don't forget to leave us a review on iTunes.